So we're talking risk management. We'll talk about your papers a little bit more, maybe tonight and Thursday night, so you can start getting working. The real key is that you pick your bank and start reading. Get that risk management section. Anybody remember the sections? You start off with what?
Overview.
Overview of what?
Risk management.
Of the risk management function. Do you start with the section who the bank is? Yeah, you could do that, but it makes sense. This is the JP Morgan's the largest bank in the United States or in the world? Are they largest in the world or in the United States? Well, you could do total assets, you could do market cap. Do y'all know? It's interesting. When I was where you are, or a little after, there were a lot of banks in the United States. JP Morgan was a very small, it wasn't called JP Morgan Chase at the time. Pretty small bank. I remember when State Street crossed $100 billion. I thought that was amazing that there was a bank with $100 billion in assets. That's crazy. Now we have multi-trillion-dollar banks because they all merged. There was one point in time where Texas, the state of Texas, had more banks than the entire world outside of the United States. And so there's been a lot of consolidation coming on. So you might think JP Morgan's this massive bank, but it has not always been. Have y'all heard of the Bank First Chicago? Union, not Union, oh, I can't remember the names of them. Nationwide Bank, you've heard of them? Yeah, have you? Okay. So Texas Commerce Bank, if y'all heard of them? Oh, really? So they're still in that, okay. But a lot of them have merged, right, and come together. As JP Morgan is amazing. They bought out First Chicago and a bunch of other banks. And so you might have an introduction. Then you're going to talk about the risk management. What's your focus on the risk management section on the intro part?
How they define.
Well, that's no market risk, right? But you could list the risk and how they define each risk. You're focusing on market risk, but the intro, you could say that here's the list. What do we call that? The universal risk. Here's our universal risk. You could certainly make that part of it. You might define each one of them quickly. That would be good to do. Where would you start first? Starts with a P. Their philosophy. What's their philosophy on risk management? You start with that. Then you talk about process, which I think that's where process makes sense, where you have what risk are they covering? What else would you cover in the intro? It's really important. What's a big part of process?
Mission statement, the mission,
Well,
vision.
that gets into the philosophy. How high up is risk management in their mission statement? But it's people, right? Do they have a chief risk officer? What's their committee structure? If you have a board, well, you're going to probably have an audit committee that's separate from the board, works directly to the board, doesn't report to the CEO. You're looking at the people, looking at committees. If you can get a picture of their committee structure and put it in your paper, that would be good, and try to figure out. It's really, really difficult to figure out their process because I think you're going to find it somewhat convoluted. Most of these banks are so massive. I mentioned at USA, we kept it simple. We had one corporate committee that handled everything. The subsidiaries had their own thing, but they all reported. Very few of these banks have that because they're so complex and so massive. Then once you finish that, then you start in the market risk. And real simple, market risk has how many pieces? 3, and they are what? Define, measure, mitigate. What are you going to do under measure? It's going to be value at risk. It's going to be stress testing. It's going to be net income, economic net income. What's going to be under mitigation? It's going to be diversification, the most important one, but there's going to be some risk controls and risk budgets and some other things. We'll get into those. I have a list of the ones you probably should see, but start reading that and get a sense of what's going on with your bank. If you start now and do a few pages a day, you'll be able to get into it, really sink into it, and help you in interviews because you're doing some stuff that most undergraduate students don't do. I don't think most students realize how complicated the annual report for a bank is. It is pretty amazing, right? Some of y'all started as like, my word, this is not written for the general public. These are complicated entities that do some really complicated stuff. So, right, any questions on your paper so far? You should have started reading. Definitely have picked your bank by now. Yeah, so your introduction is everything but very limited. So you overview, but when you get the market risk, you can get much more detail. They may write 5 pages on value at risk, you get that down to a page or so, but you're going to definitely talk about value at risk. You will definitely have charts in your paper from your company's annual report. They all have a value at risk chart. They have other charts that are very much related to what we're doing. All right. So before we get into balance sheet immunization, which is very related to what you're doing with your banks, I want to do a little bit of a stepping back to stuff you've had before and just remind you of stuff you had in previous classes. I took it from Peter Bernstein's book, Against the Gods, a really, really good book. And there's four things he talks about that are really pretty key to risk management. Huh? Oh, y'all got to tell me that. Thanks, Jessica. We would have been sitting here all night. So yeah. Well, it's on the should be on the YouTube. Any other questions on the class? Did y'all get my email from the class? So I've had students like some say it's super journalistic, but I'm going to send you email every week. If you don't need it, just delete it. But I want to tell you what you should be working on every week. And then you get the video from the class. So, all right. So 4 things he talked about that I think are really, really critical, that hopefully you remember these, because as a finance major or an actuarial science major, this is stuff we use a lot. So let's see how many of these you remember. Statistical inference. Anybody remember that? How would you do statistical inference? You'll talk about that in your stats class. So you have a sample size and you're trying to forecast what? Population. All right, that's statistical inference. What did your stats class say about a larger sample size? Is that good or is that bad?
Good.
Good. Do you need 2 million sample size, or would 100 be good enough? Sometimes 100 is good enough, but is 200 better than 100? Yeah, but at some point it doesn't help you all that much. So, and that gets to the second one, law of large numbers. If you have a large enough, obviously if your sample size is the population, you've got a pretty good sample size. You know exactly what you're dealing with. So those two are closely related to each other. He talks about in his book, this guy named Bernoulli, I get them mixed up, there's 2 brothers, but he thought you could have what this was moral certitude, that you have a large enough sample size but you know exactly what's going on. There's no doubt whatsoever. That may be true in some areas, but we're talking about finance here. What about reversion to the mean? Have y'all heard that one before? Cool.
Talk about regression on actually the mean of the regression.
A regression model you might incorporate reversion to the mean. Reversion to the mean says if something's been above average for a long time, what's it likely to do going forward? Be below average. All right, we'll talk about reversion to the mean. And in correlation diversification, we're going to talk a lot about that, especially in the second exam, because this is, you can see in this class, on the first exam, we're going to talk about borrowing to invest. And I'm going to argue that academia has it right and practitioners have it wrong. When we get to this type of stuff, especially in your project, I'm going to argue that academia has it wrong and practitioners have it wrong. I think we do some really, really bad things in finance. We rely so heavily on correlation and diversification. We talked about, when I was showing you the annual report for Bank of America, remember I showed you, where's the diversification in here? It's right there. Look how much that reduced risk. Extremely important to their process, right? Their value at risk would have been $107 million, $170 million. But because they say these things don't all move at the same time, these are 1% events, they're not all going to be at the 1% event at the same time. Is that a good way to run a business? We're going to talk about Doug Hubbard. What does Doug Hubbard talk about? He talks about when you have these unexpected collisions where everything moves together. He calls it contagion. What is contagion? It's when things that are normally uncorrelated suddenly become correlated. And what happens in that case? You've grossly understated your risk. Because you said these things can't all happen at the same time at their 1%. This might lose you 29 million, 1% of the time, but when this one's down, this one's likely to be average or 2 million or whatever. But contagion means there's some event that suddenly all of these things become correlated. And if that's the case, you're grossly understating your risk. How often does that happen? Well, 2008, that happened. COVID, that happened. You have events where everything just crashes. So last Tuesday, the stock market crashed and the bond market crashed. Why did they crash last Tuesday? Because Trump said something, right? And I'll ask you this later in the class. Are stocks and bonds positively correlated or negatively correlated? The answer to that is yes. Yes, they are. Sometimes they're probably correlated, sometimes they're not, and you have to understand when. But if your entire portfolio is, I'm diversified because I have stocks and bonds in my portfolio, that sounds really good, except for when. When they're positively correlated. Do y'all know when stocks and bonds are positively correlated? When did they both fall? They both fell in 2022. What happened in 2022 that would cause stocks and bonds to both fall at the same time? We're going to talk more about this later. Which one? Well, what happened? Well, real estate might actually done kind of okay in 2022. Although that's a good point. I mean, there are times where in 2008, really, the real estate market, but what happened to bonds in 2008? Treasury shot up, corporate bonds crashed. We'll talk about that one. Bonds aren't all bonds, right? Treasuries, they shoot up in a crisis. Corporate bonds shoot down. But 2022, what was everybody talking about? Inflation. What do stocks and bonds do when inflation takes off? They both crash. So when someone says, I'm well diversified because I have stocks and bonds, you can say, yeah, unless inflation shoots up again, then you're in trouble. So what can you buy that's going to protect you from inflation? Maybe real estate, maybe gold. How did gold do in 2022? It was actually down. How did tips do in 2022? Y'all know what a tip is? An inflation-linked treasury bond. That sounds like that should do great in 2022, right? It did horribly. The thing you bought to protect you from inflation was actually down in 2022. What helped you in 2022? Real estate might have protected you some, but not much. So you see that contagion? You think you're diversified? Hey, I got these tips in case there's inflation. I got real estate in case there's inflation. I got stocks and bonds in case there's a crisis. 2022, just everything was just crashing in 2022. It was pretty bad, except for maybe oil prices. How many of y'all have 40% of your portfolio in oil? You probably hope you don't, right? Right now, you'd be in bad shape. So that's that contagion effect. We say, yeah, these are uncorrelated, so we can subtract out a lot of the risk because they don't happen all at one time. But is there an event where they all suddenly become correlated? And if that's the case, you're grossly understating your risk. So that's a big issue on this concept of correlation diversification. Are you really as diversified as you think? If all you have is stocks and bonds, you're not very well diversified. I'm going to pick on the guy who wrote Random Walk Down Wall Street. I'm going to show a video he wishes he probably never made, where he's talking about diversification, which I strongly disagree with him, and you'll see why I disagree with him when we get to that point. So when we look at each one of these, you want to know their definitions. As a finance or actuarial major, you should know them. How we apply them in finance and how we misuse them in finance. So statistical inference says take a large enough sample size and you can predict what the population is. That works pretty well in certain areas. So let's take height. If you want to figure out the population of heights of men living in San Antonio, how many men would you have to sample to get a pretty good idea of the population height in San Antonio? Would you need 80,000 men? Probably not. Probably 100 would be all right. What if you did a sample of 200 men and you looked at a sample and you would predict the population? What would you say the probability of 50-foot tall man would be? What would your data tell you? 50-foot tall man, you would say 0%. What about a 3-inch tall man? That's going to happen. All right. Would you be pretty confident in that? Okay, how tall is the spur guy? He's over 7. There's some college student that's like even taller than that. But would your data be shocked to see him? It'd probably say pretty low probability, but you wouldn't be just absolutely shocked. All right, so it works pretty well for heights. Let's try wealth. You do 200 people in San Antonio to get their wealth. What would be the probability of a billionaire? About the same as a 50-foot tall man. Practically impossible. Would you be shocked if there's a billionaire? Wouldn't shock you. And yet your statistics say it's impossible. And why is that? Because height is very normally distributed and wealth has a very fat tail on the upper side. How large would your sample size? I don't know who the billionaire, I used to say Red McCombs, but I don't think he's alive anymore. But there's got to be at least Tom, what's the guy who owns the, is it Dallas or whatever? Tom something. There's someone here in San Antonio. There's at least one billionaire here in San Antonio, or let's say Texas. How large would your sample size have to be before it tells you that their billionaires exist? Well, it needs to be large enough until the first billionaire shows up in your sample size. All right. So there are some distributions that there's almost not a large enough sample size because they're so skewed and you have these really extreme events. You would actually, if you sample 200 people, you'd probably find that the probability of someone having $10 million would be impossible. And that doesn't seem all that wild. And then you get one person with 10 million, suddenly it shows up. So a lot of times in finance, the sample size is just, there is no sample size large enough because there's these extreme events that are way out in the tail. They happen so infrequently that your data says they're absolutely impossible, and yet they do happen. And we've seen those. If you look back at COVID, some of the data we had coming out of COVID for stock market changes and bond market changes, some of those look practically impossible. So just my career, I may show you the data later. There were weeks in 2008 where we had on a daily basis 7, 8, 9 sigma events. According to Microsoft Excel, an 8 sigma event is impossible. 8 standard deviations from the mean is impossible in one day out of a 100 trillion. And yet I had weeks in 2008 where we had those days every single day. So does that mean I really went through a week where it was 1 in a trillion to the trillionth power every day? Or does that mean the statistics are wrong? That our distribution is not so normally distributed? They were pretty rough weeks. I didn't sleep a lot those weeks. When you had the market down 10% one day, up 8% the next day, down 10%. The weirdest thing for us was at the end of the day, because markets are so volatile, the brokers were covering their books. And so we go through a normal day, and in the last 5 minutes, the market would drop 5, 6%. And you're just like, don't give me another one of these days. It was just crazy. So there's something wrong with the sample size that we say it's impossible for the market to fall more than 10%. And yet it had those kind of days, 2 and 3, 4 days in a row. So part of our problem is what our sample is and what our population is. What we're doing in finance is we're sampling history to predict the future. And your statistics professors will say that's wrong. You shouldn't draw your sample outside of the population. You should draw it from the population. If you want to get the average height of a man in San Antonio, don't go look at 200 men in Costa Rica. I go to Costa Rica. They're a little bit shorter than the average American there. Some, except for one guy who's like 6'4", but he's kind of the exception. But most of us are much taller by a couple of inches. Don't draw your sample size from outside of the population. But what do we do in finance? We're sampling history to predict the future. That's the problem. Another problem we have is the distribution itself is changing. So the world is changing. We're much more interconnected. You can have events that in the past couldn't happen because we weren't all that interconnected, but now we're so interconnected. We know with these plagues, these viruses going around the world today, with people flying everywhere, we're spreading germs much faster than we were in the past. The world is changing. People talk about global warming or AI. We have all these things coming up. Is AI going to change distributions in the future? I'm looking forward to the day where AI is structuring portfolios and competing with AI, and AI is trying to figure out what AI is going to do, and AI is trying to figure out what AI is. How does AI perform when it's competing against itself? And we're just sitting back there, hoping they know what they're doing. So the world is changing. Demographics are changing, markets are changing, cultures, environments, everything is changing. So it's possible when we're sampling the history that's distribution doesn't make any sense. And you can kind of figure this out on your own. If you're sitting December 31st, 1969, and you're trying to figure out how the 1970s are going to be, my guess is you're going to be way off. I'm betting most of you looking back at the last 50 years are not going to predict double-digit inflation, oil prices shooting up. You're probably not going to get that at all because you haven't seen anything like that in the last 50 years. So it's tough. Predicting the future is pretty tough. The other problem we have is because we're sampling in the past, history actually changes the future. As we go through 2008, we act differently going forward. So it actually changes the way we behave. We learn from our mistakes. There's I don't know if I can get into his book, Dr. Lowe, Adaptive Market Hypothesis. I can't spell, but Dr. Lowe, Andrew Lowe, he's at MIT. He has this theory called the adaptive market hypothesis. He essentially says markets follow an evolutionary pattern, just like evolution in science teaches, but are much more rapid. That we learn, we change, we adapt, and because of that, the future is different than the past. He has an entire book on it. It's a good book. It's an interesting book. Great professor. There he is right there. He's been in San Antonio a few times. Great guy. But that's his whole thing is we evolve, we change, we learn, and because of that, we act differently, we behave differently, and so we can't really use the past to predict the future. We rely heavily on statistical inference primarily because it's all we've got. If you're trying to predict the future, what are you going to use if you don't use the past? Are you going to sample the future? That's kind of tough to do, right? You can have AI create kind of fictitious futures and you try to sample that, but what is AI going to do? It's going to rely on the past as well. So it gets really tough. But we do it a lot because we just don't really have much else to rely on. You're going to see on your risk management project at the end of the semester, I use things like return, risk, correlation, heavily dependent on the past, because that's all we got to work with. We rely heavily on the past. So I'm not telling you not to use statistical inference, but just always be a little bit leery about what the past is really telling you about the future. I mean, China's very different today than they were in the past. Russia's very different today than they were in the past. The world is just so radically different than it was during most of my lifetime. And that relates to the law of large numbers. So Bernalli talked about moral certainty, where you have a large enough sample size that you know exactly what's going on. You have exact precision. The problem we have in finance is we have this idea that if we have enough data, we're smarter. But sometimes what having more data does is actually fool us, that we have this confidence that really we shouldn't have. We're desperate for data. We try to get a lot of data. AI is heavily using data. Just does it a lot faster than we can. It has access to a whole lot more data than we do. But is more data always going to be better for you? We're getting more and more powerful computers. They're destroying, our energy grid, using a lot of electricity. One thing I think is important for undergraduate students is on the data side. You need to learn where is the data, where does it reside, how do you get your hands on it, and then what do you do with it when you get it. So where's a good place to get good data? Well, Bloomberg. So you also have a Bloomberg account, right? We were doing that earlier in my secure analysis class, bring data in. How does Bloomberg do that? pretty well, right? You can bring in 3,000 companies and bring in many, many years of data on those companies and compare it to how the stock market reacts. You can bring in a lot of data. So that's where the data resides. How do you get it? So all of y'all should definitely be Bloomberg experts and Capital IQ experts. And if you're not, I would learn it really, really fast before you graduate because you see it a lot. You want it on your resume. How many of y'all have Bloomberg on your resume? A couple of you, Bloomberg Market Concepts, Capital IQ, you can get that certification. I had never heard of Capital IQ 6 years ago, but as I talked to alums, they kept bringing it up, Capital IQ, Capital IQ. So I took a whole summer and just learned Capital IQ so I could see where that data is, and it's really, really, really good. But so you need data. It's really important. You should really, undergraduate, be focused on where is that data, how to get my hands on it. So our UTSA library does a good job of giving you Bloomberg and Capital IQ, and there's probably some other sources out there as well. Some students I have are really good at writing code, the strip stuff from the internet. That can certainly be a good way to do it if you know how to write Python or something. So you need data. The problem is when you over rely on it, and that's the thing called data mining, where you think you have information, it's just noise. It's fooling you, this precision that's not really there. How can you handle that? Well, one thing I think is really important is don't use all of your data. Reserve some of it so you can test things out of sample. So I inherited a mutual fund I had to manage. I hated this mutual fund, but the guy who built it, it was a trading mutual fund where he traded off these different signals. And he used every single piece of data he had, and he showed it to me and he said, "Hey, what do you think?" And I said, well, one thing that bothers me is the Friday before October 17th, when the market fell 23%, your model said to sell on that Friday. So obviously your model did really well because you avoided a 23% drop. The problem is you're trading on information that wasn't available until after close on Friday, which means you didn't trade until Monday. So your model's off by a day, and it's a 23% day. So that kind of worries me. So he went out 3 more decimal places, and then the model had him trading on Wednesday instead of on Friday. He says, "I fixed it." So I don't know if you really fixed it or not. You fixed that one day, certainly helps your model. And I inherited that portfolio and I did not like it at all. I had to put my own money into it. And what's the minimum? I asked my boss, what's the minimum I can put in this portfolio and say I'm invested in it? Because I did not like it. It was over data mined. You know, when you're going out 2 more decimal places just so you can avoid one bad period. So what should he have done? He should have built it and then left a period of time where he didn't test it and tried it on those 5 years to see how it would have done. Or how do hedge funds do it? What is their out of sample? Their out of sample is actually the future. So they'll incubate a fund for 3 or 4 years. So they build all the data. They say this is how we're going to trade. And before they offer it to the public, they test it with actual real life data going forward into the future. So that's good. You test it out of sample. So be careful to do that. Don't use every single piece of data you have. Reserve some periods. Sometimes you can do something real simple where maybe you have this trading rule that says if this happens, overallocate the growth stocks. If this happens, overallocate the value stocks. It works really, really well. Well, then take it to Europe and see if it works in Europe with European stocks. If it works in the US, it should work in Europe. So test it out of sample just to see. So that's really good. Don't overuse your data, thinking that more data gives you more confidence. I mean, it will give you more confidence, but maybe it shouldn't. Reversion to the mean is just a natural tendency for things to move back to average over time. We see this in nature. If a 7-foot man marries a 6'8" woman, will they have tall children? Yes, but their children will be shorter than they are. So if that wasn't the case, what would happen? You would have 50-foot tall man. So nature somewhat naturally does that. We see that in finance. You see a company growing really, really fast, but they're not going to grow 20% for growth rates forever. Otherwise, they become the entire world's economy. They just can't. You know, it's tough. You know, you're looking at some $5 trillion companies now with NVIDIA and 4 trillion. I think Google's pushed up there. It's really hard for a $4 trillion company to grow 20%. Growth rates just get really, really tough. You just kind of naturally revert back to the mean. So if you're above average for a while, you probably should assume going forward, you're going to be below average for a while, and probably is a better assumption. It works well in finance. When I was running models at USAA, I would put reversion to mean into my models and say, okay, if the model gave me 5 years of great returns, I wanted to err on the side of below average returns going forward, just to try to push that in there. So you can definitely apply that. It's absolutely true. If you're hiring a mutual fund manager, you're better off hiring one that's had 3 bad years than hiring one who's had 3 good years. It's not tremendous. It's not obvious, but portfolio managers that have 3 below average years on average outperform managers whose last 3 years were above average. Now, would you actually do that? Go out and hire someone and say, hey, how'd you do last 3 years? Oh, not very well. Okay, I want to invest with you. Because what do firms do, like Fidelity? They only bring you the managers that have done well the last 3 years. So at USA, when you interviewed managers, we wouldn't look at their performance. We would listen to their process, listen to their ideas. And then once we heard that, we'd say, okay, man, you must have had a really, really rough 2023. And then we look at 2023 and they had a really great year. It's like, hey, wait a minute. You're either not managing the way you said or you changed something. Doesn't make sense. We don't mind that they had a horrible 2023 because we like their process. That makes sense, but 2023 doesn't work with that process. But going forward, we think it's a good idea. It's smart. Like, yeah, it doesn't bother us at all. You had a bad year. And in reality, we're almost glad you had a bad year because it means, your time is coming. The things that underperform are probably going to outperform going forward. So where are we right now? What's been performing really well the last 5 years in the stock market?
Yeah.
Tech stocks, AI companies. So where could you go that hasn't been performing well? Value stocks, small cap, they've done really well the last few months. Will they continue to do well? They're starting to look expensive. But essentially at USAA, we used to graph value versus growth stocks. Value stocks are these really, really weak companies, have a lot of debt, they haven't done well, they're really cheap companies. Growth stocks are these great companies, they're growing great, but they're very expensive. And if you look at them over time, you'll see there is a cycle. Growth outperforms for like 7 years, then value outperforms for 7 years. So when would you move from growth to value? After growth has had 7 great years, and you might move over to values. That's that kind of reversion to the mean. When is it misapplied? It's thinking when it's going to revert. Because some of these cycles can go on a very, very, very long time. This growth cycle has been pretty intense. Most of my career, everybody just talked about buying value stocks. Don't buy growth stocks. They're expensive. You're going to underperform. Buy value stocks. Whole books were written about that. And then now we've had this period where growth has really outperformed for such a long time. It used to be any long period you looked at, value outperformed growth. It had a higher return at lower risk. And people are saying like value stocks are just the place to be. That's kind of the Warren Buffett approach to investing. But today, when you look at it, growth has outperformed because it's had such a long stretch here recently. Does that make you want to buy growth or does that make you want to buy value? Well, if you believe in reversion to the mean, you probably want to load up on value now and avoid growth. But when? At what point? We'll find out tomorrow, right? Tomorrow on Thursday, because you have Meta and Microsoft and Apple reporting here pretty soon. Apple reporting on Thursday. So we'll find out if is AI overvalued or is it still got legs to it? Who knows? I'm not making any investment recommendations. You're on your own. So there's 2 phrases that are really dangerous in finance. It's different this time and it's not different this time. That's where reversion the mean comes in. So the Japanese market in the late 70s, no, late 80s, people were saying Japan was just killing all other stock markets. It was amazing. And their stocks are so expensive. And people say, oh, but it's different this time. Japan's a different economy. They're smarter than we are. When I came out of college, it was like US, we're all stupid. Japanese, they're all smart. We don't know what we're doing. They're so efficient. They got it all down. So the stock market was taking off. Everybody's like, it's different this time. Don't worry about Japanese stocks looking so expensive. Has nothing to do with them. They have PE ratios 150. In the US, it's like 20, 15, but that doesn't matter anymore. It's different this time. And then what happened after 1989? The Japanese market fell 85, 90%, and it just recently hit an all-time high. So it took it like 40 years to get back from what it lost in all of that time. Was it really different this time? Or did valuation matter? Valuation mattered. It wasn't different. But sometimes we say it's not different this time when it really, really is. There's a portfolio manager a few years ago. He was sticking all of his customers into cash because interest rates were so low. And he says, interest rates are going to rise. We'll just stick it in cash. When rates rise, we'll move. And year after year after year, his customers are making like 0.5% in cash where they could have made 5% if they'd been in bonds. He said, well, it's not different this time. Interest rate's going to move. He might have been right, but he was like 5 years early, 6 years early. And his poor customers were making such low returns because he kept thinking, stick them in cash until interest rates move. So it's tough. Which of these mistakes are you going to make? Probably both of them. Why do people make this mistake? Because they're jumping on bandwagon. They want to be in AI. AI is different this time. It's going to take over the world. Why do these people believe this? Because they didn't buy AI. They've been sitting on the sidelines. And they're saying it's not different. This is just like 2000 when the dot-com stocks crashed. So both of them are going to be in a lot of pain if they get it wrong. I remember 2000. A lady in my church, she was so mad at our broker. She said, my broker won't buy tech stocks. I don't know what to tell him. And she knew I was a portfolio manager. Says, Ron, what can I tell them to buy tech stocks? And I said, tech stocks are like grossly overvalued. And she looked at me like I was an idiot. As much as a church lady can look at you like that. But she's like, yeah, you're a waste. I need someone who knows what you're talking about. I wish she had listened to me because tech stocks fell by 85%. As well. But it's like I was looking at tech stocks and was like, no, I'm not going to buy those things. But she was so mad. She says it's different this time. These stocks.com, the internet's taking over the world. That's where everything's going to be. These are not expensive stocks. And she was right, but she was also about a decade or 2 decades early. They got ahead of themselves. They sold off 85%. Since then, they've come back roaring, doing really, really well. That was a time where all you had to do was put .com somewhere in your company name and your stock shot up 10, 20%. So I can't tell you when to be careful, but if you ever see yourself saying this, you're probably justifying something you want to do because you want to make more money, and you're probably just fooling yourself. If you're saying this, you're probably upset that you didn't invest in something and you're just hoping it's going to crash so you can tell your friends how smart you are. And what is the key for both of these? You'll hear this a lot. It's ego. You'll make a lot of investments and you'll make a lot of decisions, not because of the right decisions, but because it makes your ego feel a lot better about yourself. So be brutally honest and admit what you do and don't know, because it's painful. I've gone through several of these, and boy, they're not fun at all. Correlation, diversification. Harry Markowitz, the late 50s, he passed away a couple years ago. Nobel Prize winner in economics. He created the efficient frontier, which we're going to be using in your risk management project. And essentially, he said you can find a highest return at each level of risk, but you got to incorporate correlation. That's not everything moves together, and correlation is what reduces your risk. So what you want to make sure you have your portfolio and things that are not perfectly correlated to each other. So when one is up, another one's down, you've got good diversification. We're going to talk quite a bit about this one in the second half of the class. How well does it work? If you can find negative correlation, something that's up when everything else is down, that's really good. That's used to be what gold was. In 2022, gold was down, even though everything else was down. So it didn't work in 2022. Have you thought about why gold didn't do well in 2022? We had a lot of inflation. It should have done well. Why didn't anybody know why gold didn't do well in 2022? What is gold like? Likes inflation. What else is it like? 2 other things. It likes low interest rates, and it likes a weak what? Weak dollar. All right. 2022, we had inflation. Interest rates shot up. That doesn't help it. But what really killed gold in 2022? The dollar. Dollar shot up in 2022. How could the dollar shoot up when we had inflation? Because inflation was global. Everybody had inflation. The US dollar did better. So here you have all your portfolio sitting in gold that protect you. You put like 20% in gold. It's like, don't worry about inflation. I got it covered. I got my gold, and then gold is down. Why? Because the dollar is strengthened. Pretty frustrating, right? You thought you had it figured out, and it just did not help you at all. Really, really frustrating. When I was responsible for USA's 401k plan, so we took from 3 options to 13. I felt pretty good about that. And after I left that department, they added a new option called the inflation option. And they put gold and they put real estate investment trust stocks in there. And can you imagine you invest in your 401k plan and it's an option to protect you from inflation, and you get to the end of the year and it's down a bunch? Would that make you happy, or would you be pretty upset? And I remember talking to the guy who did it. I said, man, your real estate investment trusts, they're high dividend yielding stocks. They hate it when interest rates shoot up. They look like a bond. They crash. And what did interest rate do in 2022? They shot up. REITs just crashed. Why? Because people look at REITs as a substitute for bonds. So, and then they had all this gold that didn't do well. It's like, I said, I wouldn't have started that fund, because it's really hard to manage inflation. It's really, really tough. And I sure don't want someone down 10% a year when inflation's up 9%, and they're going to like, what did you do to me? So it's tough. All right, so we'll talk about how correlation's handled. I'm going to say sometimes diversification works fairly decently well. If you have a portfolio, you're better off having 20 or 30 or 40 stocks than having 2 or 3. I do think that having a diversified stock portfolio works. When it comes to asset classes like US stocks, non-US stocks, bonds, I'm not so convinced, and I'll show you why. And it comes back to that contagion. You're going to discover that diversification works really, really well, except for when you really, really need it. We talked about that last class. That's diversification. And why is it? Again, it's that contagion. There are certain markets where just completely unexpectedly everything becomes correlated. Now, in 2008, that wasn't the case, because treasuries did really, really well. Treasury bonds, if you'd had long treasury bonds in your portfolio in 2008, you would have been making 60, 70%. But then in 2022, what did treasury bonds do? They were down 20, 30%. So they helped you in 2008 in a crisis, but they hurt you in 2022. So it depends on the particular scenario, and that's what we're going to talk about later in the class. You're going to see a famous paper that says correlation doesn't actually even exist. It's not stocks and bonds don't have a correlation. It's just their historical relationship. It has nothing to do with how they actually react. The more important thing is the environment. What environment are you in? What's driving markets, and how do those things correlate? And so I'll show you the environment argument there. So we fail to recognize correlations are not stable. And the worst thing is things become the most highly correlated at the worst possible time. You just, like a 2008, everything just crashes all together. All right, so those are the 4 that I got out of his book. You should have seen most of those before, and we'll deal quite a bit with this last one in particular. Our typical measures of risk, you should have all of these formulas memorized. So everybody should know the standard deviation. Can anybody tell me the formula for standard deviation? Use it a lot in finance. You takers. You know a lot about how we define risk in finance by these formulas. So what do you start off with standard deviation? It's X minus X bar. What is X minus X bar? Each data point minus its average. Doesn't that tell you a whole lot about risk and finance? What does finance define risk as? How far can you be from the expected value? That's how we define risk. We do not define risk as like losing money. Warren Buffett does, but finance doesn't. We don't say risk is losing money. We say risk is how far you can be from expected value. If you expect 8% and you lose 50, is that risk? That sounds pretty risky. If you expect 8% and you make 58%, is that risk? Finance says yes, right? Because you find risk not by how much money you lose, we find risk by how far you can be from the average. If you're not very far from the average, that's low risk. If you can be really far from the average, that's high risk. And then what do we do with it after we take the difference? You square it. The squaring do it does two things. What happens to your negative numbers? They go away. Everything's positive. So all we care about is the distance. We don't care if it's above or below. What else does it do? When you square it, big differences have a big impact. Small differences have almost no impact. So it gets rid of your negatives. So you only care about the distance, and outliers have an overwhelming impact. One outlier, like in October 87, when you had a 23% down day, if that day is in your data, it's going to have a huge impact on your standard deviation. If it's not in your data, you're not going to notice it. Correlation, exact same thing, except for what do you need with correlation? You start off with the data minus its average. What else do you need? For correlation, can you do correlation on one thing? Let's have two things. So very interesting. For correlation, you notice we're multiplying here. Here we multiply it by itself, so you got rid of negative numbers. But do you get rid of negative numbers here? No, with correlation. So what are we looking at with correlation? Some people say, did they move together? But that's not right on correlation. What correlation is asking is, when X is above its average, is Y also above its average? When X is below its average, is Y also? If they're both above their average and below their average at the same time, you get nothing but positive numbers, right? You multiply two positive numbers by each other or two negative numbers by each other. How do you get a negative number? When this one's above its average, when this one's below its average, or this one's below when this one's above. That's how you get negative numbers. So correlation is looking at how two things move, not to each other, but how they move relative to their own averages. Are they above average or below average at the same time? And what does beta do? The exact same thing, except for what does beta do? It makes one of them a market, right? So beta is doing the exact same formula. The formula for beta and correlation are almost identical. They both take this, they take the average. So you take the sum of all these, take the average, and that equals, anybody remember what that is? The average of those multiplied differences starts with a C, if that helps you any. Covariance. The correlation and beta have covariance. Anybody remember the rest of the formula? Correlation is covariance divided by what? Any takers? Some of y'all know this and you're scared you'll get it slightly wrong. You should be bold. So correlation is covariance divided by the standard deviation of X times the standard deviation of Y. Is that coming back to y'all? Y'all remember that? And what is beta? It's covariance divided by any takers? Standard deviation of Y. I think you said it. Yeah, so it is the market, but with one exception. Remember, beta only covers systematic risk. So we leave out the stock specific risk and we do the standard deviation of the market times the standard deviation. We only have the market risk. Because correlation, what's the highest correlation can be? 1. What's the lowest correlation can be? -1. All right, correlation can be 1 to -1. What's the highest beta can be? 87 trillion. There is no limit. What's the lowest beta can be? Negative 8 billion. There's no limit. So correlation is between -1 and +1, but beta can be any number because it's a relative, the covariance relative to the market risk. That's how you get a 1.1, 1.5. You really should know these formulas. They're pretty important. At value at risk, we're going to talk about 3 ways to do value at risk. We're going to be using the parametric approach. We'll talk some on historical and stochastic, but there's 3 ways to do value at risk, but you'll see the value at risk on the parametric side. It's pretty straightforward. I don't know if y'all have had duration. I don't teach my investment class anymore. We talk about duration there. You should know the formula for duration. It's a really, really simple formula. And it was kind of humorous in my investment class. I told them you got to learn the formula because you just can't do equal duration in Excel. And sure enough, Excel added equal duration as a formula now. So you actually can do equal duration in Excel now. But duration is the measure of risk of what? Anybody remember that? What asset class would you use duration with?
Debt.
With debt, with bonds. So it's a measure of the interest rate risk of bonds, but really it's you can do the duration of stocks. How sensitive are stocks to changes in interest rates? You can do the duration of real estate, but we primarily use it with bonds. It is a very, very simple formula. You should know that formula off the top of your head. It's a really simple formula. You shouldn't know the convexity formula off the top of your head. It's a much more complicated formula, but essentially that's how duration changes as interest rates change. So it's like the second order. Convexity is really, really important. We don't talk about it in this class too much. I do talk about it in my investment class, but pretty important. And in credit ratings, that's a subjective number, but that can be really, really helpful. You get a rating, so you're looking at an entity and giving you a credit rating. Those are the most common ones, but if I were a finance major, I would know that one, that one, that one, and that one from memory. I'd have an elect to look it up. As a finance major, finance formulas are like anatomy to a medical student. You just know them off the top of your head. You don't have to look them up. I know you have professors that give you formula sheets. You should demand that they not. I know the rest of the class would hate you, but you got to know these formulas. How important is it? Well, if you have a pain in your side and you go to the doctor and the doctor walks in, says, that's interesting, and pulls out an anatomy book and says, yeah, let me see which side the appendix is on, because it could be an appendicitis. How long would you stay in that office? Would that make you a little nervous? That's a finance major that doesn't know these formulas off the top of their head, because we're formula driven. You just got to know them. They're simple formulas, and I love the fact that standard deviation, correlation, and beta it's almost the same formula 3 times. Slight variations, but it tells you a lot about risk and how we measure risk. Duration's a very simple formula. Convexity is a pain. And you'll see the value at risk formula we use is pretty straightforward. My property and casualty class, if you are in there, we're going to use stochastic value at risk in that class. Pretty simple to do. We're not going to actually run the models. I'm going to give you the results of the model, but it's pretty simple to do. Some of y'all have had that class before, right? And remember, you're taking it now. But yeah, you'll see it's pretty simple to do. Actuaries love this kind of thing where they run 1,000,000 scenarios and they just rank them, the lowest risk to the highest risk, and they just pick some cutoff point. They say, hey, we have a 1% value at risk. So they just go down from the 1% from the end, and that's their value at risk. They just run millions of scenarios, pretty straightforward. USAA does that with hurricanes and earthquakes. Works really, really well, pretty simple to do. Historical VAR, which is what most of your banks do, they don't run simulations. Their simulations just history. They look at the last 100 days or 200 days, and they let that define their distribution. That works really well until when something suddenly happens, like 2022, and interest rates shoot up, and then it doesn't work so well. But we're going to be using primarily parametric value at risk, which is really the simplest one of all. All right. So that's the background. So we're going to get into my favorite risk. It's my favorite topic. So I have students come to me and they're like, what should I do for the next 50 years of my life? They want me to just lay out their whole career path. And it's like, yeah, it doesn't work that way. First of all, you don't know what you like. Secondly, you don't know whom you're going to run into in the hall. We're going to talk about black swans. My entire career was decided in like 4 instances. It's just so radical. So when I was where you are, I never heard of balance sheet immunization. I didn't know what it meant. Have y'all heard that term before? And then suddenly 4 years later, it's my most favorite thing on the planet. I love it. I'm talking to actuaries, which makes me feel stupid and smart at the same time. They're all a lot smarter than I am, but also it kind of makes me fun that I can kind of figure out what they're saying and follow them. And so balance sheet immunization is how you manage interest rate risk, primarily banks, insurance companies, especially life insurance companies, pension plans. It's how you manage interest rate risk. Can you think of a bank that didn't manage interest rate risk well in the last 3 years? Like Silicon Valley Bank messed up on the basics. So what we're going to talk about here, if you had worked for Silicon Valley Bank, you could have saved them because it's not that complicated. Your bank may have interest rate risk as a separate, you saw with Bank of America that they listed interest rate risk as a separate one, and it was almost their biggest one. Or what was their biggest one? So between credit risk, for most banks, it's between credit risk and interest rate risk. They're 2 biggest risks. So we're going to talk about how does a bank manage interest rate risk. Interest rate risk is usually a subcategory under market risk, and you're doing market risk for paper 1. So watch out and see if they get into detail on interest rate risk, because it really is a really important one. I'm not having you do credit risk because it's just too much, but you'll usually see credit risk in a completely different area. With these banks, they all have credit risk as a separate area, but they may have interest rate risk as a special topic under market risk because it is such an important topic. How to define interest rate risk? It's just interest rates change and causes your assets and liabilities to move in ways that cause you to lose net worth. Maybe your assets go up 5%, but your liabilities go up 20%. Or maybe your assets fall 10%, but your liabilities fall only 5%. So that's interest rate risk. Highly important for banks, even more important for life insurance companies. And then we're going to do a special carve out on pension plans. Banks are pretty good at this. Life insurance companies are exceptionally good at this. By far the best in the business. And I'm going to argue pension plans are way out there doing it exactly wrong. All right, so I'm going to argue that they're doing it exactly wrong. It's going to be a big essay on the first paper. Now, it's not just if interest rates change, but it's which part of the interest rates change. So you probably had yield curves in your economics class. You took money in banking, you probably talked about interest rates. I remember the theories about why interest rates are what they are. You have the expectation theory, you have the liquidity theory. But yield curves normally do this orange line. Short-term rates, 1-month rates are generally lower than longer-term rates. Generally. Why is that? Some people say it's because we expect interest rates to rise. Some people say it's because it's the liquidity premium. You're worried about inflation. So to commit your money for 10 years, you better get paid a liquidity premium for locking in for 10 years because inflation could take off. And some people just say it's supply and demand. There's just more people demanding 10-year bonds than demanding 1-year bonds, or the other way around. So that's a normal curve. This is not too normal because I drew it when interest rates were really low. There are some things as finance majors I would have on a little piece of paper in my wallet. One of them is the normal difference between the 10-year and the 2-year rate. And you should bring that in. The normal difference is about 0.7. So if the 2-year rate's 2%, the normal 10-year would be 2.7. I would have that as a normal so that you kind of know when the yield curve is abnormal. Right now, you can see the 10-year is at 4.24 and the 2-year is at 3.53, about 70 basis points. We're back to normal. Right? What was the yield curve in 2023? Does that look normal? The 10-year was 352 and the 2-year was 419. What do you call that? Inverted. What's the inverted yield curve telling you? Recession, right? And did we get the recession? No, it missed it. As they say, the yield curve has predicted 10 of the last 7 recessions. Sometimes it gets it wrong. We've never had a recession without an inverted yield curve, but we've had some inverted yield curves without a recession. I think the strangest one to me was 2019. I don't know what month we have to go into. Yeah, I can't find the exact month, but we had a recession in 2020, but it's all COVID related. But we did have an inverted yield curve right before that. It didn't last very long, but it's kind of strange that the yield curve even predicted a recession of COVID, which came out of nowhere. This is a great site. It shows you historically. You can do it. If you want to bring historical data in, you just type H15 and just H15. I don't know what it means, but it gives you the St. Louis Federal Reserve and it gives you interest rates. If you just click on historical data, you can get daily interest rates for the entire yield curve back to before when I was born. You can believe that existed back then. So you can get back to the early, well, I won't tell you what year, but back to well before your parents were born. Data. You just click on it, go to download, and you just download it. And suddenly you have interest rates on a daily basis. The only problem is they leave the holidays in. I don't know why they do. So you got to take all those NDs out. But if you look at it, the 10-year, we usually look at the 10-year versus the 2-year. There's the 1-year. There's the 2-year. There's the 10-year. The problem using the 10 versus the 2 is that the 2-year doesn't have as much history. So some people use the 10 versus the 1, but you can do either one of those. But if you look at the yield curve here, if you go back not too far, the yield curve was pretty flat. And especially in 2023, it was inverted, but it's been pretty flat. It's just recently we've gone back to normal. What does a normal yield curve say? Inflation's under control, the economy's doing well, everything's really good. I don't know if that's the correct forecast, but that's what the bond market is telling us. So inverted yield curve predicts a recession. A very steep yield curve usually means the economy is really strong. We're probably going to have some inflation. And so people are investing longer. They say, I need a higher yield because inflation is going to be there. It's going to be strong. I need to be paid more for that. So you can have a flat yield curve, an inverted yield curve, a normal yield curve, or a steep yield curve. These are important. If you're a bank, banks tend to loan out longer than they get deposits. So they somewhat like steeper yield curves. They like loaning out auto loans at 6% and having savings accounts paying 1%. That's kind of nice, right? You have a 5% net interest margin. Life insurance companies like one thing and one thing only, and that is for rates to never change. They just like stability. And we won't talk about life insurance companies. We did in my life insurance class last semester, but they do not like volatile interest rates, mainly because they buy very long-term bonds, like 10-year bonds, and then they pay that to their customer for 10 years. But if interest rates change a lot, their customers say, you know what, I can get a bank CD, pay me 8%. I'll just take my money out and go buy the CD. And they're stuck with this 10-year bond. So life insurance is so tough, but they're very, very good at what they do. So understand the yield curve. Go in and see the difference between the 10-year and 2 years. Have a good sense of what that is. So if you go into an interview and the 10-year is only 10 basis points higher than the 2-year, you know the yield curve is really flat. That's telling you something very different than if the 10-year is 150 basis points higher than the 2-year. That's telling you something very different. Just bringing that up in an interview will separate you from 95% of the competition. Just be able to say, man, the yield curve is really steep our yield, what I've been saying in our blog is the yield curve has been really flat and just recently it's gone back to normal. The bond market is telling us things are back to normal. I don't know how the bond market can think that, given what's going on right now politically and other things. Seems kind of weird, but the bond market seems really, really comfortable that things are doing well. All right, so it's steepness. How does it move through time? A parallel shift is as everything moves up and down together. Non-parallel shifts, life insurance companies actually have to run scenarios. So to them, it's not are rates rising or falling. To them, it's which part of the curve is rising, which part is falling. That's really important to them. They actually run there's hundreds of scenarios to see what impact it will have on their business. And that's part of the stress test you see banks doing is they got to run different interest rate scenarios just to see what happens to their book of business in different scenarios. So here's some sites that you can get interest rates on. Or if you have a Bloomberg account, Bloomberg has all these interest rates. You can just dump them in. We have a spreadsheet that just brings in the 10-year rate. Every time you load the spreadsheet, brings up the latest numbers, and you can just bring it in automatically. All right. So what assets and what liabilities are sensitive to interest rates? So the most obvious is bonds. They have the most direct impact. We'll talk about this specifically when we talk about banks. Stocks look like they have interest rate sensitivity. If you remember the dividend discount model, you're taking next year's dividend divided by an interest rate plus beta times the market risk premium. Anybody remember what this formula is? Risk-free rate plus beta times the market risk premium is CAPM by who created this? William. It's a really smart guy, really sharp guy. William Sharp, yeah. So, and then minus growth. What did interest rate do in 2008? They dropped dramatically. So stocks must have gone up a bunch in 2008, right? Did stocks go up a lot in 2008? Even though interest rates were down, right? If you reduce the denominator, the value of stocks should have gone up. But what happened in 2008? The risk premium shot up and the expected growth rate shot down. So the risk premium and the growth rate more than offset the benefit of interest rates falling. So yeah, stocks supposedly have a lot of duration. They have positive duration. They should go up in value when interest rates fall. They should go down when rates rise. But there's other factors that affect stocks that are far, far more impactful than just interest rates. Real estate. Again, real estate is valued a lot like stocks. You have a discount rate, you have a cap rate. It implies when interest rates are low, real estate's worth more and opposite, but there are other factors going on with real estate that have impacts. And there's different types of real estate. Some real estate looks like a long-term bond. If you have a 20-year lease with a really high quality tenant, that looks a lot like a bond. They're going to pay you rent every month for 20 years. That looks like a bond. It's fixed income for 20 years. But if you have a hotel property, you can change your rents every night. That one looks like a short-term, like a money market account. You can change your rates every day. So real estate has different durations depending on the kind of contract you have. When I was at USAA, we actually calculated the duration of our real estate portfolio and matched it up with the debts. So you can do that. You want to make sure you don't have a 20-year lease on a property that you're funding with 3-month debt. Because you got this lease for 20 years, and if interest rates shoot up, your cost of debt's going to shoot up, and you're getting that same amount. So if you have a 20-year office lease, what kind of debt do you want? You want 20-year debt, so that the two match up. So you can definitely do some real estate interest rate analysis. Loans, which is just the opposite of bonds. The bonds, when you're the investor, loans when you're borrowing money. Loans is on the liability side. They're sensitive to interest rate. Loans and debt. Deposit accounts, these are all interest rate sensitive, which banks have all of that stuff. So they have some interest rate risk. The interesting thing with a bank is they have interest rate sensitive on both the asset and liability side, and they're both customers. Banks are a unique entity where they have customers on both the asset and liability side. On the asset side, they have auto loans, mortgage loans, and on the liability side, they have deposits and certificates of deposit. So they're pretty unique. Life insurance companies, their customers are all on the liability side. Life insurance companies, they buy corporate bonds and then they pass those earnings on to their customers that are on the liability side. But banks are really, really unique where they have customers on both sides of the balance sheet. And then we'll talk about pension liabilities. Maybe the most sensitive thing to interest rates there are. If interest rates fall a little bit, these liabilities shoot up a bunch. They can shoot up 20, 30% pretty fast. We'll talk about them in detail. So we're going to focus in on banks to start off with. We'll talk a little bit life insurance, and then we're going to spend quite a bit of time on pension plans. We won't talk about REITs, but they are sensitive. We'll kind of indirectly talk about the Pension Guarantee Corporation, but we're going to spend most of our time on banks and pension plans. You might say, why pension plans? Because they don't really exist anymore unless you work for the government, but you're going to learn something really that works for you as a personal investor looking at them. All right, so next class, we're going to start doing some math. So bring your calculator. We're going to be using this formula quite a bit. And we are going to immunize the balance sheet of a bank, right? I'll stop there. So you work on your paper Tuesday. I'd like to have some discussions what you're finding with your banks so we make sure everybody's on track. We'll get a little more discussion. So this weekend, really work hard. After this weekend, there's a really important essay. It's actually my favorite question to ask on an exam. And I got a blog on it, and we'll start talking about that. It's a really tough question. It's my favorite question because it draws absolutely everything you do in finance is all captured in one question. So it's like the world's greatest question for finance. So we'll get into that. It's related somewhat to what we're doing here. What we're going to do tonight is we've got this bank. It's got a balance sheet, and we want to manage its exposure to interest rates because we're doing interest rate risk. And we're going to do that by doing something called balance sheet immunization. You know what immunization is? You take some shot. Doesn't absolutely prevent you from getting disease, but it should reduce that. That's what immunization is. We're going to walk through this problem, and most students the first time through is like, wow, that's way too much. I can't keep all that in my mind. The math is really simple. The formulas are pretty simple, but there's a process. But after we work 2 or 3 problems, it should get really simple. The exam question is exactly like the examples, other than the numbers are a little different. So there's no, in fact, I don't know why 100% of students don't make 100% on that question. It's simple math. It's very straightforward stuff. For some students, like if you don't give me a formula sheet, I can't do it. And that's really sad for finance. Y'all can tell I'm on this big thing of what should finance people know off the top of their head. And I know we're in a new world where, eventually Elon Musk is going to put a chip in your brain and you're going to have instant access to ChatGPT, and it doesn't matter what you memorize or know, you don't need to know. Do you think we get to the world where it doesn't matter what you know, you can just click on a, tap on your head and suddenly it finds it? So I'm in the old world that what you know is what makes you valuable. That's why I love finance. Finance pays you for what you know. So what do you know? How many pages could you write from what you learned last semester off the top of your head without looking anything up? That's what they pay you for, is what you know. So these are simple formulas. Should you memorize them? No, you should just know them. There's certain things you should just know in finance. All right. Should you memorize your brothers and sisters' names? No, you just know them, right? There's certain things you just know. It's kind of embarrassing. Oh, let me look up your name. I can't remember. I know you're my brother, but I can't remember. No, there's just stuff that you know as a human being, as a finance major. When you stick that word professional next to your name, it's just there's stuff off the top of your head you just know. And I mentioned some last class with standard deviation and beta and those type of things. There's just stuff finance people know. I actually have a list of what those are if you ever want that. A list of stuff that you as a finance major should know off the top of your head without thinking twice about it. So if you work in the financial sector, industry, this is one of those areas. Duration is really important. If you don't know the formula duration, come catch me in the FSC sometime. I can show it to you. If you took my investment class, we do it in that class. It's a really easy formula, but we use a lot in finance. And there are a lot of finance majors who graduate with an undergraduate degree in finance who never dealt with duration. And then they're going to interview You interview at Victory Capital, I mean, duration is just, they're shocked if you don't know it because it's just so second nature to them. So it's a good number to get into your brain. We're not going to calculate duration. We're going to already have it calculated. We're going to use it in the problem, but you should know how to figure out how to calculate duration. So it's a good number to know. The technical definition, you've heard the term maturity. So if you have a 30-year mortgage, what's the maturity? Well, it's 30 years, but that's not the duration. All right. Maturity is just when the very last cash flow is paid. Okay. If you have a 5-year auto loan, what's the maturity? It's 5 years. But is that the duration? If you loan money to the US government and you buy a 10-year bond, treasury, what's the maturity? It's 10 years. What does duration do? So how many of y'all have had duration before in this class? Nobody? Are y'all lying to me? No one's ever had, have y'all heard of duration before? This is the first time? All right. So you haven't had my investment. I stopped teaching in the investment class. So that's kind of the problem. I'm going to start teaching that again. I think it's really, really important. So what duration says, maturity doesn't tell you much. What duration says, let's look at all the cash flows. And let's take a weighted average of the cash flows to get the true exposure to interest rates. So a big difference between a 30-year treasury and a 30-year mortgage. Can you think what's the biggest difference between a 30-year mortgage and a 30-year treasury? What does a treasury pay you every month for the next 30 years or every 6 months?
In the annual.
But what is that payment based on? Are they paying you interest and principal or just interest? Interest only. All right. If you have a 30-year mortgage, what are you paying every month? Interest and principal. What's it called? That's an amortizing loan. An amortizing loan, you're paying principal and interest. So what happens to your cash flows? They're moved up a lot, right? A 30-year mortgage, you get a lot more cash flow up front. With a 30-year treasury, all you're getting is interest. When do you get your principal? In 30 years, you get it all in one day. So a 30-year mortgage might have a duration of, say, 10 years. A 30-year treasury might have a duration of 18, 19 years. Why? Because your cash is pushed back. So duration is taking the weighted average time to maturity using all your cash flows, principal and interest. All right. Why are 30-year mortgages priced off of the 10-year treasury? Is because they have about the same duration. All right. Because the mortgage, what about your auto? You borrow money on auto, you're paying interest or interest and principal? And so a 5-year auto loan might have a duration of 2.4 years because you're getting your cash flow spread out pretty evenly there. All right. So that's what duration is. It's the weighted average time to maturity. It's using those discounted cash flows to weight. So you have 6 months, a year, 18 months, or doing monthly, whatever. You're taking the weighted average of all those cash flows, but you're using discounted cash flows to do it. You're not using the actual undiscounted cash flows. So duration is a much better measure of your exposure to interest rates than maturity is, because it really depends on when you get those cash flows. So assuming we have duration, how do we use it? Well, duration tells you very directly your exposure to changes in interest rates. Yeah. This is a formula every finance major knows off to the top. Oh, well, I take back. This is a formula every finance major should know off the top of their head. All right. The percentage change in the price in something equals minus duration times the change in interest rates, change in yields. Why is it minus? Because what do bond prices do when interest rates rise? Bond prices fall. What do bond prices do when interest rates fall? They rise. It's an inverse relationship. All right. So if your bond portfolio has a duration of 5 years, and interest rates rise 100 basis points, how do you expect your portfolio to move? It's going to be minus 5 years times interest rates rise 100 basis points. You expect your portfolio to fall 5%. Pretty straightforward. So don't memorize this formula. This is a formula you should just know off the top of your head. That's not a very difficult formula though, is it? Pretty straightforward formula, minus duration times the change in yield. I had a boss, one of my bosses in finance, he used this formula all the time. Oh yeah, that's going to fall about 3.7%. He knew the duration. He could do it really quickly in his mind. Oh, sorry. I have no idea who that is. Wow. Maybe it's Deborah Cunningham. I don't know who that is. All right. Now I'm curious. Because 97% of my calls are from some guy named Spam, and I don't, Deborah Cunningham. It's a really useful thing to do when interest rates move, you know how much you're going to lose just by looking at duration. Is it perfect? It's not perfect. How do you make it perfect? By adding convexity. We're not going to talk about convexity. I talk about that in my investment class. Convexity tells you how does duration change as interest rates change. So it gives you some curvature. But if interest rates don't change much, like plus or minus 1% or 100 basis points, duration does a pretty good job of estimating how your bond portfolio is going to do. Now, I'll say everybody in finance should know this formula. I will say Money Magazine about 25 years ago had a front page. The front of the magazine was all about duration. And so USA's customers are calling the investment company at USAA and asking what the duration or bond portfolio was. And the portfolio managers at that time didn't know. It was the old generation that came up in the 60s and 70s. They didn't use duration. So they didn't know the answer. They're all out scrambling. What's the duration of our portfolio? The group that came after them all knew duration. So there was a shifting. Which something I think about a lot is how do I prevent becoming a dinosaur? Because they had not been paying attention or reading up and they didn't know what duration was, how it was calculated. And the group behind them, 10, 20 years behind them, they knew it very, very well. There's a famous guy in finance named Ibbotson, Roger Ibbotson. He discovered duration in the 70s. And you should listen to his podcast. He's talking about how easy it was to make money in the 70s when he understood duration and no one else in the bond market understood it. He understood the risk, interest rate risk, duration. He says, man, that was the easiest time to be a bond investor because we had data that was pretty simple to calculate, pretty simple to understand, but most of the fixed income world didn't know it. So yeah, it's not a recent concept. Since the 80s, we've all known it, but there was a changing of the guard. So duration is useful to have. If you were to buy a bond portfolio, a mutual fund, you'd want to know the duration of that portfolio. The typical bond mutual fund has a duration of about 5 years. I can give you some terms. Well, there's 3 categories: short term, intermediate term, and long term. A short-term bond fund might have a duration of about 2 years. So if interest rates rise 100 basis points, that portfolio could lose about 2%, not very much. And that's just the price. So if the yield is 4%, you'll make 4% in yield, but you'll lose 2% in price. So you only make about 2%. All right. A typical intermediate term bond fund will have a duration about 5 years. So if interest rates rise 100 basis points, it might give you a yield of 4%, but you're going to lose 5% on the price. So you'll end up losing 1%. And then long-term bonds, maybe 9 years or so. A 10-year treasury has a duration of 8 to 9 years. So if you put all your money in 10-year treasuries, it should be somewhat long-term. But it tells you your risk, right? Because if your duration's shorter, your portfolio is not going to be as kind of susceptible to changes in interest rates. And if you have a longer term bond, so what would you want to do if your boss says rates are falling this year? Which of these bond portfolios would you want? Your boss thinks rates are going to fall. Do you want short-term bonds or long-term bonds? They're falling. Long-term, right? If interest rates fall, you have minus duration. Remember, it's minus duration times the change in yield. If interest rates fall 2%, what is this portfolio going to do? Minus 9 times 0.02, it's going to shoot up 18%. If your boss says rates are rising this year, what would you want to do then? Short term. And you kind of intuitively knew that. You could buy a treasury today yielding 4.2%, but you know rate's going to be much higher tomorrow. What would you do? Would you buy the 10-year today or would you wait and buy it tomorrow? I'd wait and buy it tomorrow, right? If you know rates are rising, you don't want to commit yourself out 5, 10 years. You want to wait until the rates rise and then you commit yourself. All right, so we use this a lot. We're not going to do this necessarily in this class, but it's good to know duration. It's really powerful, really useful. Convexity to me is even cooler, but we don't have time to talk convexity in here. But it's an interesting concept. If you want to study this more, just type modified duration in Wikipedia, and Wikipedia does a really good job discussing duration and convexity. You can get everything you need in Wikipedia. I like Wikipedia better than Investopedia. Investopedia is a little too simplistic, so maybe you start with Investopedia, get the big picture, and then go to Wikipedia for the detail. If you do this, I don't know how to spell Wikipedia. I don't know if that's close, but if you do this, what you will discover is a bunch of really interesting, look at there, right there, convexity, right there in the top. The formula for it is so simple. This was Macaulay duration. So what is this formula? What this formula down here is the price of the bond is the present value of all its cash flows. That's real simple. What's the difference between the numerator and denominator? What did they add? Time. That's all they did. So duration is just that weighted average time to maturity of the bond. It's a really simple formula. That's Macaulay duration. They give you modified duration, but there's other durations out there. You can see they go into it in quite a bit of detail. Macaulay duration, if I were the people in charge, I would call it Macaulay duration. We use modified duration because Macaulay had a slight error in his formula, so they fixed it. They should have just given it to him and called it Macaulay duration, but we call it modified duration. He left one little simple adjustment out there. But there are other out there. There's convexity. You shouldn't have the formula for convexity memorized. It's far too complicated, but it is a good concept to understand. You'll see the term embedded options. I mean, there's just so I'm tempted to go off on a tangent because I love this topic. It's really interesting. It's just there's so much here. You have little links over here on the side. They're all really interesting. So there's a lot there. We're doing banks though. For banks, it's fairly simple to use these formulas here. When you get the life insurance companies, that concept of the convexity becomes really important. For banks, it's not quite as important or even nearly as anywhere close to as important as life insurance. But we're going to stick. So this is the formula. You won't use this formula on the exam directly, although you will, well, kind of indirectly you will. But it's an important formula to know. Oh, there's a link right there. So convexity is that second order. If you want to get a more precise measure of how your portfolio is going to move, it's actually minus duration times the change in yield plus convexity times the change in yield squared divided by 2. What this tells you is because this is squared, when you square a small number, you get a really small number. What that means is convexity really doesn't matter unless interest rates change a bunch. They got to move a lot. If they don't move a lot, you hardly notice convexity. One of my students, if any of you are interested in this, email me. One of my students built a internet site that shows you directly how to duration convexity. It has the convexity formula in it. If you want to just see it, it's a really interesting site. You can actually see convexity. So none of y'all have had my investment class, right? I haven't taught it in that many years.
Can you say that to get the relation?
I don't know who that is, but boy. Okay.
Is the expected value of the cash flows to get the duration?
Well, it's the present value, not the expected value, present value.
Oh,
Right. So you get a discount rate, you discount all the cash flows. Those discounted cash flows, you multiply each one of them by time. If it's 6 months, you multiply it by 0.5. It's 2 years, you multiply it by 2. So, and then you just take the weighted average of that, and that's your duration. Yeah. I wish I could show you because some of you are like, it doesn't sound easy, but it really is a very easy calculation. And Excel does have a formula now for duration in Excel, amazingly. It's actually the modified duration, not the Macaulay duration. So it's a powerful stuff because in one number, you have a pretty good sense of where your exposure is. If rates rise or fall, you know your exposure. If you have long duration, you're expecting rates to rise, you better do something because your bond portfolio is going to drop a bunch. In 2008, when Treasury yields dropped a bunch because of the crisis, long-term Treasuries were up 50-60% because they had a long duration. And yeah, Treasuries can really help you in a crisis because in a crisis, interest rates generally fall quite a bit. And long Treasuries have pretty long duration. A 30-year Treasury might have a duration of 18, 19 years. Interest rates fall 300 basis points. You're up 40, 50, 60% pretty quick. So yeah, if your boss says, hey, we're going to have a recession next year, interest rates are going to plummet. Yeah, let's stick all our money on long Treasuries because yeah, they're going to shoot up in price. All right, how do we mitigate this interest rate risk? We're going to use balance sheet immunization. So what I'm going to do is walk you through this problem. Would look a lot like on the exam. Do your best the first time just to let it kind of sink in. We're going to do some stress testing. Here's what a stress test looks like. You're going to see this in your bank's risk assessment. If interest rates change these amounts, how much is your net worth allowed to change? So we'll be calculating that. What the board is telling them, if interest rates rise 100 basis points, what is 100 basis points? You take 100 and divide it by 10,000. So 100 basis points is 1%. We do things in basis points, so get used to basis points. So if interest rates rise 100 basis points, that is if the 10-year goes from 4% to 5%, the board saying your net worth can't fall more than 5%. If interest rates rise 200 basis points, they go from 4% to 6%, your net worth can't fall more than 10%. Same thing on the downside. If interest rates fall 200 basis points, you also don't want your net worth to fall more than 10%. So what they're saying is, hey, you can bet on rates falling, but if you bet on rates falling and you're wrong, make sure you don't lose more than 10%. You can bet on rates rising. If you bet on rates rising and you're wrong, your net worth better not fall more than 10%, right? So the board's telling them, this is what we did at USAA. We did 100, 200, 300 basis points. I think most of your banks do 1 and 200 basis points. I don't know if y'all seen that yet, the table where they change interest rates. They may look at net worth. They may look at net income. They may look at net interest income. They may look at different things. Some of them look at economic capital, economic earnings. Anytime you see the word economic, so if they're looking at not net worth, but economic net worth, what they say is, what is our net worth if we value everything at market values versus GAAP accounting values? All right. But look for these things. You should see something similar to this. Most of your banks will have something like that. All right, so here's the formula that you need. You don't get a formula sheet. So the duration of the duration of the net worth of a bank is this formula. It's the duration of their assets minus their liabilities in dollars of their assets in dollars times the duration of liabilities times their leverage. So DA is duration of assets. I give you duration of assets. You don't have to calculate the duration of the assets. I give you the duration of liabilities. I give you the dollar amount in liabilities, the dollar amount in assets, the dollar amount in net worth. Leverage is your dollar amount in assets over your dollar amount in net worth. It's that kind of kick of how levered are they, and how levered are banks? It's pretty shocking. You remember I told you I was shocked when State Street went over $100 billion. So here's good old JP Morgan with $4 trillion in assets, 40 times. Now Walmart, if you look at Walmart has $260 billion in assets and $97 billion in net worth. So something a little better than 3-1. All right, 3-1. What was JP Morgan? more than 10-1. They have more than $10 in assets to $1 net worth. They have very little room for error. These are incredibly highly levered firms. All right, you don't realize how, I mean, that's almost, wow, 4 billion over 345. That's 11.6-1. What happens if they can't handle that? Are we going to have to bail them out? Can we let a $4 trillion entity go under? And what do we say with, some of y'all have seen this in JP Morgan. What do they say? Fortress balance sheet isn't what they say. Does that look like a fortress? If their assets fall 10%, they're insolvent. Any of y'all have your assets fall 10% ever? So very, very leveraged entities. Citibank's not much different. 2.3 trillion and 200 billion. These are very, very highly levered institutions. So you're gonna see that leverage is gonna have a huge impact on the risk. So you take assets over net worth, and you'll get some, I don't know what I use my problems, but you can get something much, much larger than you would see in normal companies like a Walmart or a Costco or someone. Just these entities have a lot of, and it's not debt, a lot of liabilities, deposits and other things. All right, so this is the formula. You just got to know this formula. You don't just take duration of assets minus duration of liabilities. Why? Because assets are larger than liabilities. You have more assets than liabilities, so you have to make that adjustment. The impact of the duration of assets is going to be greater because you have more assets. So we make that adjustment. But then the whole thing is levered up because we're looking at net worth and assets and liabilities. When you make that leverage adjustment, which can be 10 or more to 1, it has a huge impact on the duration of net worth. So what do we really want this number to come out to? Most banks will keep it at a pretty small number because they don't have much room for error. Banks are going to have a duration net worth of 15 years or something like that. It's going to be a pretty small number. Banks generally don't bet on the direction of interest rates because they're not all that good at predicting that. So let's work for an example. The first time through, it's going to be tricky. So just kind of do your best to kind of stick with it. And then this weekend, do a little practicing on it. But here's a bank that has cash, $150 million, loans of $850 million. So they have $1 billion in assets. The duration of cash is 0. Just by definition, if you have a money market account, that duration is 0. If you really think interest rates are going to rise, then stick all your money in a money market account, wait for rates to rise, and then go invest. So money market, pretty short. Their loans have a duration of 5.2. Now, that is a really, really long duration. Because remember, if you have auto loans, you might say 5-year auto loans, but 5-year auto loans don't have a duration of 5. They have a duration more like 2.5 because they're amortizing. You might say, well, they have mortgages. Mortgages are 30 years. 30-year mortgage might have a duration of 10 years. But what do banks do with their mortgages? They send them off, right? They put them out into the asset-backed market. So banks don't really hold on to mortgages. They sell them off to the market pretty fast. I was shocked at USAA. They might have $15 billion in loan, and they'll send 14 billion of that. They'll get it off their books pretty fast. So this 5.2 is a pretty long duration for the loans. So what is the duration of assets? And it's pretty straightforward. The duration, this is true for your portfolio. The duration of your portfolio is just the weighted average durations of the individual pieces. Real straightforward. So we had 150 in cash, 15% in cash with a duration of 0, 85% in loans with a duration of 5.2. So our duration of our assets was 4.42. I make sure everybody sees the math on that. Weighted average through. You can't ignore this piece if you want to, because 0 is 0. Just say 85% is at 5.2, so that gives you 4.42. Now, I'm giving you these numbers, but who actually calculates these numbers? So USAA was the bank CFO that calculated the numbers. It is not easy to calculate these numbers. The auto loans are pretty straightforward. If you have any other type of loans, they're pretty straightforward. What about a credit card? What's the duration of a credit card or a bank? So the question you're going to ask is, how frequently can they change interest rates? How frequently can they change the interest rate in your credit card? All the time, right? So the duration on a credit card is pretty close to zero from a bank standpoint. It may be a couple of weeks while they're waiting for you to pay your bill. So credit cards have very, very short durations. Auto loans are in a 2 to 3 year duration. A mortgage, 30-year mortgage, and about the 10-year duration. But the real challenge for banks is on the deposit side. The loans, they can do pretty well. The deposits get a little bit tough, but they do. When we calculate duration for USAA, man, it was a massive spreadsheet. You have to bring in every single thing that you have on your balance sheet, and you got to calculate each of those durations. But once you get the duration of each piece, the duration of the entire thing is just a weighted average of all those little pieces. This is true for your bond portfolio. If you have 20 bonds in your portfolio, you get the duration of each bond. You just take the weighted average, and that's the duration of your portfolio. It's real straightforward. All right, questions on this? The duration or net worth of their assets is 4.42 years. I'm sorry? Well, this is them loaning money to other people. This is auto loans. So that is an asset for a bank. Well, they'll call it an auto loan. So if a bank doesn't auto loan, they're loaning you money, you got to pay them back. Yeah, I mean, so banks have something called the loan to deposit ratio. What's loan deposit? It's the loans assets that they've made over the deposits, the liability. So yeah, you think of loan as a liability, but the bank is making a loan. So think of it from the providing cash. Then on the debt side, I say debt. We know banks have a lot of deposits, but I'm just going to say debt. And the only debt they have is 750 million, and it has a duration of 375. Now that could be 10 pieces of debt, but again, the duration of your debt portfolio is just the weighted average of the individual pieces. This is where it got really complicated at USA because USA had deposits like checking accounts and savings accounts. The CDs were easy. It's really easy, certificate deposit. It's really easy to come up with the duration on that. Really, really simple. But we had a big debate on the checking and savings account. What is the duration of a checking and savings account? And it's really, really hard to come up with that number. So they did 2 scenarios. They did it with and without the deposit accounts, and we got two radically different answers. And we had to kind of decide which of the answers we're going to go with. So it can get pretty complex, but I've done all the work for you, and I'm just giving you the number. So that's the duration of their liabilities. So what we're trying to figure out is what is the duration or net worth? We want to know how is their net worth of this bank? How much is it exposed to changes in interest rates? And we're going to calculate that using the duration of net worth using this formula right here. We're going to take the duration of assets minus the relationship between how much they have in liabilities versus assets times the duration of liabilities. For this number to be 0, the duration of liabilities has to be greater than the duration of assets because liabilities are smaller than assets. You'll see that very, very quickly here. So let's calculate the duration of net worth. What is 4.42? Anybody remember that number? Duration of assets, 750. Your debt, your liabilities, the billion. Total assets, 375. Your liabilities, and then there's the leverage. $1 billion is your assets, 250. Your net worth. You get a duration of net worth of 6.43. I say years. I've had someone debate me. The duration is not in years, but to me, it's in years. I don't know what else it would be if it's not years.
How do you get the 4.2?
That's what we did here. So we said cash is 150, had as a duration of 0. The loans was 4.2, so it's really 85% of 5.2 gives us 442 because the cash has no duration. right? So this is the only time you're going to, this formula I gave you up here, minus duration times the change in yield. This is the only time you'll use it on the exam is this question. I'm going to try my best not to confuse students in it. This question is just, it's not related to anything. I'll just throw it out there to make sure you know that formula. So some students try to take this question and relate it to question number 4, but it's not related, right? This is just a question thrown out there. And I ask, how would the company's net worth change if interest rates were to fall 150 basis points? All right, so 150 basis points is 150 divided by 10,000, or 0.015, 1.5%. Remember, the change in net worth is going to be minus duration times the change in yields. Here, minus duration, the duration of their net worth is 6.43. You notice I put a plus sign there. So it's minus duration. Duration net worth can be negative. Here it's positive. I make it really clear that duration net worth is a positive number. So I'll put the plus sign there. Times interest rates are falling. So times minus 0.015. If they had a duration of 6.43 years in their net worth and interest rates were to fall, their net worth would actually grow 9.645%. That sounds pretty good. They had a pretty long duration net worth, interest rates fell, they come out ahead, they win. That's kind of Silicon Valley's scenario, except for what? Interest rate didn't fall. What did they do? They rose, so went the opposite direction. Questions on this?
Can you go back to two for a second?
We'll do this many, many times, so you'll just have to get used to that formula. Now, where did I get this formula? This was on part 2 of the CFA exam. That was the first time I saw it. I took it back to UTSA and I was actually teaching the bank finance people this stuff. They're like, man, it's really cool. It's really good. But now it's really, I mean, I kind of got it in the CFA exam leading edge, but it's now very common. But at that time, it was pretty new. That's how old I am. Now we could check it. You could say, what would happen to their assets if interest rates were to fall 1.5%? So their asset duration is 4.42. So minus 4.42 times minus 0.015. Your assets will rise to $1,066,000 because that's going to get you 6.6%. What would your liabilities do? Your liabilities is a duration of 375. So minus 375 times minus 1.5. Your liabilities would go up. They'd rise from 750, 792. So your net worth would change from 250 to 274, which is exactly that 9.645%. So you can actually calculate the pieces if you want to, but this is what I'm looking for on the exam is this piece right here. You don't have to do this part down here, but that's their exposure. Now you might say, well, that's great. Their net worth went up 9.64%. But what's the board going to say? Well, now question 4 has nothing to do with question 3, all right? Don't try to relate them because this is 150 basis points, but your board doesn't have 150 basis points. It's not anywhere on there, all right? So they have 100 and 200. But the board said, hey, if interest rates fall 100 basis points, your net worth can't fall more than 5%. But if interest rates fall, their net worth would actually go up 6.43%. Right? You would take minus 6.43 times 0.01, right? Rates fall minus 0.01. Your net worth would go up 6.43%. Did they meet the board policy? The board say, hey, if rates fall, your net worth can't fall more than 5%. Their net worth actually goes up 6.43%. They're in good shape. Now, overall, do they pass? Where did they fail? If interest rates rise, what happens? Interest rates rise 100 basis points, minus 6.43 times 0.01, their net worth would have fallen 6.43%. Is that in compliance? It's not. And they say, yeah, but rates fell. The board says no. Yeah, you're right that rates fell, but you're lucky this time. You're taking too much risk. We don't want that kind of exposure. Unless you can prove to us you can perfectly predict interest rates, we don't want you making those bets. And is that fair? You put all your money in one stock and it goes up 10%. Was that a smart move? Or were you lucky? From a risk management standpoint, can you be lucky and be wrong? You're still glad you did it, right? But what do you need to do? You better fix that problem. So this bank, they were lucky, rates fell, but the board says, no, you shouldn't have been taking that kind of risk. There was a study done a few years ago where they tested economists to see how good they were at predicting interest rates. You would think if they had no skills at all, they'd be 50-50. Rates rising or falling, you think they'd be right 50% of the time and wrong 50% of the time. They were wrong 63% of the time. We're not good at predicting interest rates. So it's pretty tough. So the board doesn't want them making those bets. What could the duration of their net worth be and they be in compliance? 6.43 is too high. What's the highest a duration net worth could be? 5 years. Who said that? Ah, very good. Have you done this before?
No.
All right, so you're in good shape. Very few students get that. How does she know it's 5? Because you do minus duration, and the duration's 5, times the change in yields, 0.01. What do you get? Minus 5%. What does the board say you can lose? 5%. So as long as the duration of net worth is 5. What's the lowest the net worth duration net worth can be? If positive 5 is the highest it can be, what's the lowest it can be? Minus 5, right. So if I do minus 5 times minus 0.01, what's going to happen? You're going to lose 5%. If your duration is minus 5 years, interest rates fall 100 basis points, you lose 5%. So what is the board essentially telling them? Duration of your net worth needs to be between negative 5 years and positive 5 years. It can't be lower than negative 5 years. It can't be higher than positive 5 years. That's what the board is telling them. Get that in your notes because a lot of students forget about the negative 5 years. They have exposure both ways. The board doesn't want them making big bets. Not say, positive 5 is too high, but you can be negative 20 years. No. Most you can be on the low side is negative 5 years. So watch for this in your bank's annual report. I have seen several of your banks do at least the 200. They don't do the 300, but they do at least the 200. All right, so they're out of compliance. And we want to get them into compliance. The duration of their net worth is too high, all right? So this is the part you're not going to get the first time, most of you, but try to let it sink in. I don't know why I did this for negative 6 years, but if the duration of net worth is too low, duration of net worth is too low. I can just kind of write it out versus doing the notes. All right, let me just give you the entire answer right here. If duration of net worth is too low, if duration of net worth is too high. In this case, the duration net worth was 6.43. It was too high. If it had been negative 6.43, it would have been too low. If your durational net worth is too low, it had been -7 or -6, what do you need to do? You need to increase the duration of assets or reduce the duration of liabilities. In our case, the one we just did was 6.43. If the duration net worth is too high, you need to decrease the duration of assets or increase duration of liabilities. All right. You want to be thinking this before you get to the second part of the problem where you're going to mitigate the risk. You got to know which side you're trying to manipulate. So if you walked into Silicon Valley Bank, you calculate the duration of net worth, and it's like 8.7 years. Like, wow, the duration of your net worth is way too high. We need to reduce the duration of our assets, or we need to increase the duration of our liabilities. How would you do that? Let's start with this second one. Decrease the duration of assets. How would you do that? Well, you could call in some auto loans, right? You could say, hey, we got some 5-year auto loans in there. We need them. Let's call them up and say, hey, you know what? Our CFO messed up. The duration of net worth is too high. Can you pay off your 6-year auto loan today? I know you have 6 more years, but can you just pay us $30,000 today? How would that go over? You call your sales department. Y'all been doing a lot of 5- and 6-year auto loans. Just don't do any for the next 3 months. I know you're getting commission to do them, but for the next 3 months, don't do any 6-year auto loans. We need to reduce the duration of our assets. Is that going to go over very well? Not going to be too popular. What about increase duration liabilities? You could push longer term CDs, right? Certificates of deposit. You could call your sales department, say, no one's buying our 5-year CDs. And they say, yeah, because our rates are terrible. Yeah, but we need you to sell them. Our CFO messed up. The duration of our net worth is too high. We need you to start selling some 5- and 6-year CDs. How's that going to go? Not going to be too popular, is it? So it will give us better rates. And sometimes it's tough to sell these. I was on the board of the credit union for USAA back when they had one. And we had certificate deposit rates of 7%. They were higher than our auto loan rates. And I was going to buy a car and I thought, well, I can, rather than paying for it in cash, I'll just take a loan out at 7%. I mean, I'll just buy a CD at 7%. I'll take an auto loan that pays 6%. I'll make 7 from the same credit union. They'll pay me 7. I'll pay them 6. And when I did the math, where did it mess up? But how? Where did I mess up? Uncle Sam messed it up. How did he mess it up? After tax, it didn't work, right? Because I pay tax on the 6%, but I don't get a tax deduction on the 7. But I thought, and I went to the president of the credit union and said, you realize our CD rates are higher than our auto loan rates? And he's like, yeah, because no one's buying them. So just because even you have good rates, if people aren't buying long-term CDs. So the problem with both of these solutions is trying to fix the bank's financial risk by disrupting operations. You don't want to do that. So what's the final solution? The final solution is magic. All right. I don't know how to spell magic. I can never remember if it's a G or a J. Does that look right? It's a G. Using what? Interest rate swaps. So which would you prefer? Disrupt operations or magic? I want to use magic. So I'm going to show you all magic. There's a way we can fix this entire problem with one phone call to one company, and we can fix it in under 10 minutes. My first interest rate swap I did, I managed billions of dollars of risk in one phone call. And it took like 7 minutes. And it's only because my broker said, I think I can get you, if rates are moving in your favor, if we wait a couple of minutes, I can get you a better deal. That's the only reason it took longer. So one phone call, JP Morgan or Morgan Stanley or whoever, and I fix this multi-billion-dollar risk. I didn't have to go out to the sales floor and say, hey man, can y'all sell other stuff? Can y'all push this product, push this product? I didn't have to do that. I just made one phone call to an investment bank and solved everything. And it looks like magic. So y'all want to learn magic, right? If you want to walk into Silicon Valley and say, hey, you got a serious problem here, I can make one phone call and we'll have that solved for you. That'd be pretty impressive for someone right out of college, wouldn't it? Let's see, fix everything for you. Same thing on this side. If the duration is too low, duration of net worth is too low, you can increase the duration of assets. What do? You push longer term loans. You want to decrease duration of liabilities. You would push shorter term deposits and CDs. Or what's your third option? Magic. All right, so we'll be using magic in here. You could use those others. Now I mentioned securitization. Securitization is something a bank could do. So banks can often, on the asset side, works better over here. On the asset side, rather than using magic, what they can do is take their longer term loans and securitize them, sell them off in the market. And they do that. That is one of their processes. And CFO does do that, but to the extent that doesn't get you exactly what you want, you can come in with interest rate swaps and fix any differences really fast. I know Warren Buffett says he doesn't like derivatives, but I tell you what, derivatives are incredibly powerful. You can fix a lot of problems with derivatives very, very quickly because you're just incredibly massively levered. All right. This probably won't sink in until we do a few problems, but that's what we're looking for. Duration can be too high. In this case, it was too high. It was 6.43 years. Or it could be too low. If it's too low, it's going to be a negative number, like -7. Sometimes I have negative, sometimes I have positive, but it can be one or the other. Questions on that? Let's see where we're going. Now y'all all want to do magic, right? So I don't know if you did this magic trick at a party, it probably wouldn't go over very well, but it works really well in the CFO department. So that's what all this is saying. Interest rate swaps. Have y'all had swaps at all? Oh, Dr. Katapackum covers swaps. How many of y'all seen swaps in a class somewhere? All right, I do it differently than Dr. Katapackum. I do it the way I felt like in the job. So it may not be textbooky, but it's what when I picked up the phone and did it, it's what it felt like. What is a swap? It is a derivative. There's two types of derivatives. Anybody know the two types? There's only two types. Do y'all know the two types? Anybody? Options and futures, exactly. So where do swaps fit in? Are they options or are they futures? So swaps are in the futures area. What's the difference with options? You buy something, it's like buying an auto insurance policy. In fact, what does your auto insurance company call the revenue you send to them? What's that called? Isn't it called a premium? What is an option? What's the price of an option called? It's a premium, right? A premium, right? You paid option premium. So options, you pay the premium, and you have the right to do something, but you don't have to. With futures and swaps, you're committed. You got to do it, right? So a swap is you're committed. Once you get into it, gains and losses are going to come your way. With options, you decide, hey, I don't like this. You can just let it expire worthless and not have to do anything. But futures and swaps, futures, forwards, and swaps, options, and insurance. Those are the type of derivatives that we have out there. We're not going to talk options in this part of the class. We will talk about them later when we talk about market risk because they're very, very powerful as well. I am a swaps person. I love swaps. My mind thinks swaps. I don't like futures. When I took CFA level 2, we had a book. It's about 100 pages long. And the entire book had one purpose, was to prove that mathematically swaps and futures were exactly the same thing. I love that book. I ate it up. I couldn't tell you any of it today. It's been too long. And they asked 0 questions on that on the exam, unfortunately. So I spent a lot of time learning stuff that they didn't ask on the exam. But technically, futures and swaps and forwards are exactly the same thing, but my mind handles swaps so much better than futures. But you can use either one. A bank can use futures, they can use swaps. They both work the same, but we're gonna use swaps because I just think they're much easier to understand, much more straightforward. The problem I had on the CFA exam is I turned the page and there's a big swaps question. I'm so excited because that's what I've been doing. Unfortunately, it was a currency swap, not an interest rate swap. And so I wasted like an hour on that problem. And if you looked at my answer, I wish I had my answer, but I kept scratching it out and writing the exact opposite. Scratching it out, writing exact opposite. I hate currencies. You'll see later. We'll talk about currencies. So I had the perfect question, swap question, but it wasn't an interest rate swap question. So you have to get a little bit of comfort with these. Let me show you. We'll probably have to next class do the math on that. Now I got you all excited about magic, but let me just show you. And where did I put it? All right. So I'm going to show you swaps contracts. So one of the risk management lessons that I think is really, really critical is infrastructure. You want to, let's say you're talking to your boss and you think, man, interest rate swaps would be really, really helpful. So you tell your boss that, and your boss says, yeah, we can do that. Well, let's wait and do it when we need it. You need to say, no, we need to do it now. So you need to set up the infrastructure. The first swap I did with, I think, JP Morgan. I had this contract sent to me. This is the standard contract that comes in. I'd never seen a swap contract before in my life. I said, that's fine, I'll read it. So I read it, and I couldn't make heads or tails out of it. I'll show you some of the language. It's like, I gotta, I'm committing my firm to this contract, and I don't know what that paragraph means. I said, wow, that's really complicated. So we hired some lawyers who specialize in swaps. They come and meet with me and say, I don't understand this paragraph. And guess what they say? We don't understand it either. It's like, okay, great. I'm glad we hired some experts. And so my question was, if this happens, this is what I want to have happen. Does that paragraph say that? They go, yes. And I look at my lawyers as, are they going to bail us out if it doesn't happen like that? But just give you an example, this is a standardized contract that they did. So that everybody could use it, supposedly simplified. If this is simplified, then I'd hate to see the unsimplified one. But so here they say, if the aggregate amount that would otherwise have been payable by one party exceeds the aggregate amount that would otherwise have been payable by the other party, replaced by an obligation upon the party by whom the larger aggregate amount would have been payable to pay to the other party the excess of the larger aggregate amount over the smaller aggregate amount. Y'all want that on your exam? Explain this in a few words. Like, it was just crazy. That wasn't the hardest paragraph. And you can tell lawyers wrote this because they're getting paid by the word. It's crazy stuff. I think I have another one highlighted, but it's just continuously like that. Here I had to go look at the definitions, and the definitions were as complicated as them being used. So this was an extremely important thing to me, because my most important thing, I mean, think about this, we'll talk about this a little later. I've got a swap of Morgan Stanley. Remember, I told you that if Merrill Lynch had gone under, Morgan Stanley was going under. So that weekend, I'm thinking, I got a contract with Morgan Stanley. I want to be like, and at that point, it's like they owed us like 300 million bucks. See, the last thing I want is they go insolvent. I tell my boss, hey, good news is Morgan Stanley owes us 500 million bucks. Bad news is they can't pay us. So I didn't want to do that. So I wanted to say, hey, I want my money today. And that was my question, is if something happens, how quickly can I get my money? I want it same day. And they assured me, but this paragraph is so important. The automatic early termination is specified in the schedule as applying to a party, then an early termination date in respect of all outstanding transactions will occur. I love this. This is lawyer speak. Immediately upon the occurrence with respect to such party of an event of default specified, or to the extent analogous thereto, and as of the time immediately preceding the institution of the relevant proceeding or the presentation of the relevant petition upon the occurrence with respect to such party of an event of default. I didn't know what that meant. It's like, when did they pay me? Like tomorrow or today? It was so confusing, and they didn't know. And this thing goes on forever and ever and ever. It's a massive contract. I finally just signed it. This is the swap contract. You also have the annex. Annex is just as complicated. The annex is specific to your contract. So you got to get this thing approved. You have to get it approved by your lawyers, by the investment bank's lawyers, by your custodian, and by your record keeper. You got 4 sets of lawyers, and one lawyer changes one word. You now have to send it to all the other lawyers again and get them to approve it. Lawyers go on vacation and they have a lot of work. I don't think they're as busy as they try to pretend they are, but they always have a high stack of stuff in their inbox. I think they put stuff in there that doesn't really part of their inbox just so they look busy. But it's tough. It can take you 6 to 9 months to get a contract like this done. If your lawyers have never seen it, and then I also have the accountant. We'll talk about the accounting side. How do you account for a swap? So if your boss says, "We'll do it when it makes sense," it's like, that's fine, but let's get the contract in place today. Because if it's going to take you 6 months, let's say 6 months from now, you really want to do this, you're not going to have time to get this thing in place. So realize your lawyers have got to review these things. Most people don't adjust the ISDA. This is called the ISDA. Most don't adjust it because it's just a standardized contract that everybody uses. But I'm kind of wondering who actually knows what this thing says. So I think for the most part, the industry just knows how they work, and no one's really all that concerned whether the lawyers got the language right or not. But it's kind of scary to me. So be aware these are not easy transactions to do. Same thing with options. Options are a lot easier to set up than ISDAs, but just be aware of that. So swaps are a derivative. Let's see how far we can get there. They're an over-the-counter derivative. So futures are exchange traded. Forwards and swaps are over the counter. You deal directly with an investment bank and dealing them. You can do swaps on a lot of things. So usually we're using SOFR. Have y'all heard of SOFR? So it took the place of the previous one. So usually you're either paying or receiving SOFR, and then you're paying or someone else is paying or receiving something else. So it can be on interest rates. You can pay SOFR and they pay you a fixed rate. You can pay them a fixed rate and they pay you SOFR, or you pay them SOFR and they pay you the return on the S&P 500. So it can be stock related. You pay them SOFR, they pay you the change in oil prices. It can be all kinds. It can be related to almost anything. It's pretty amazing. They tried setting up inflation swaps. So you pay SOFR and they pay you the CPI or something along those lines. Those don't have much liquidity to them, but it's pretty broad. Currencies obviously are a major one. Currencies, swaps are really popular with futures and swaps. And swaps are really popular with currencies along with futures. So it is a great risk management tool because you can very quickly set up a transaction that covers a lot of risk, but you got to get a lot of people to sign off. So in my case, it was 4 different parties had to sign off on this contract. Very different. All right. So how do you actually do it? Let's set this up when we may not get very far. So the way I do it on exam, this may look very different than what you saw with Dr. Katapeckham. I have 2 entities. One entity is called AAA, one's called BBB. That just happens to also be their credit ratings, just by random chance. So AAA, this table here, don't get confused. This has nothing to do with the swap. We're going to use it to calculate the swap, but this is just if they borrowed money, fixed rate, they would borrow at Treasuries plus 125 basis points. They borrow for 5 years. So if the current Treasury rate is 4%, they would be paying 5.25% for 5 years. Fixed rate, all right? BBB would be paying Treasuries plus 185 basis points. Okay, why? Because they're lower rated. Actually, this is a pretty wide spread for AAA. I'll probably have something more realistic on the exam. Usually AAA, it's like 30 basis points. All right, so if they borrow fixed rate, they would pay Treasuries plus 125, but that would be fixed for 5 years. So whatever the Treasury rate is when you start, if that's 4%, they're going to pay 5.25% for 5 years. It will never change. If they borrow floating, this says LIBOR. It should say SOFR. Sorry, I try to get LIBOR out of my notes. So change that to SOFR. The swap I had was based off of LIBOR. And when the whole thing blew up, people were suing Barclays Bank because of the LIBOR. And I said, maybe we should sue them, until I discovered that whatever they did that was not legal actually benefited us. So I was like, no reason to sue them. We actually came out ahead on that. So I was kind of happy they did it. So if they borrow, it'd be SOFR, which is a floating rate plus 10 basis points. What that means is usually every quarter, every time SOFR changes, your interest rate changes. So it's floating rate. If interest rates go up, you pay more, come down, they go down. So this one actually changes over time. This one's fixed. If triple B borrows floating rate, they're going to pay SOFR plus 20 basis points. There's something you want to do when you set up this problem. So this thing over here on the side is not on the exam, but you want to do this. You want to write this down immediately. What is the difference in interest rates between AAA and BBB on fixed rate? You know AAA is cheaper because they're higher rated, but how much cheaper are they on fixed rate? 185 versus 125. They're 60 basis points cheaper on fixed rate. How much cheaper are they on floating rate? 20 versus 10. They're 10 cheaper on floating rate, which is very, very normal. There's something called the term structure of credit spreads. You may have heard that before. What that means is when you're looking at a highly rated firm and a low rated firm, the difference in their cost of debt will be much closer together for short-term debt and much wider apart in longer-term debt. And that makes some sense, right? If you're going to loan money out 5 years, you'd rather have a safer company. And so AAA is much cheaper when you have 5-year debt. They're not as much cheaper when you have floating rate. Why do you need this difference? Because it's going to determine which side of the swap they're going to go on. Where does AAA have the biggest advantage? Fixed rate or floating? Fixed. That's the side of the swap they're going to want to be on. So what this means is AAA has a big advantage when they borrow fixed rate, but they may not want fixed rate. So what they're going to do is they're going to borrow fixed rate and then they'll swap the floating rate. So they're going to take advantage of their 60 basis points cheaper, borrow on fixed rate because that's where they normally borrow. They have a big advantage there, and then but they really want floating, so they can use a swap to switch to floating. I'll show you how they do that. Triple B has less of an disadvantage in floating. So they'd rather borrow floating, but they really want fixed debt. So what they're going to do is go out and borrow floating rate debt, and then you use a swap to fix, right? So this will make more sense. But the question I ask, and some students never can figure this out because it just seems like a weird question. If that's the case, wherever you see the bigger difference, that's where AAA has the advantage. Wherever you see the smaller difference, that's where triple B has the advantage. So who has the advantage on fixed rate? AAA. They have the comparative advantage. Granted, AAA has the absolute advantage in both, but they have a comparative advantage on fixed rate. Who has the comparative advantage on floating rate? Triple B, right? If you took economics, you talk about comparative advantage, it's the same concept. So AAA has the absolute advantage, but they have a comparative advantage on fixed, and triple B has a comparative advantage on floating. Wherever they have the comparative advantage, that's where they're going to borrow money, and then we'll swap them over to the other side, right? Now, if you've never seen a swap, this is how I give you the swap. Calculate the ultimate borrowing costs. We don't have time for this tonight, but we'll definitely do it next class. So if you're really confused right now, don't worry. We got to go through the whole problem and you'll get it. It takes us a couple of classes. If these two entities borrow where they have a comparative advantage, that means AAA is going to borrow fixed, triple B is going to borrow floating, and then enter a fixed for floating interest rate swap where AAA pays LIBOR to triple B pays treasuries plus 140 to AAA. All right, let me do the math real quickly and you can kind of see it. We have 6 minutes. It's going to be too fast. So we'll do it again next class. AAA is going to borrow fixed at treasuries plus 125. So they pay treasuries, they pay 125, that's fixed. They're gonna pay triple B what? SOFR. So I'm gonna do minus S because they're paying that. We're talking about their cost of debt, so they're gonna pay. Oh, I'm sorry. So the cost, do cost as a plus and what they receive as a negative. Sorry, I said that backwards. So they're gonna pay SOFR, so that's another cost. And what are they gonna receive from triple B? What does the problem say up there? Someone tell me so I can tell you're awake. What does triple B pay them? Right, so they're going to receive treasury and they're going to receive 140. All right. What is their ultimate cost? What happens to the T's? They cancel out. They're going to pay, they're going to pay SOFR. And then what are they left it with? 125 minus 140. They're actually going to pay, you're going to borrow at SOFR minus 15. Now, what if they just borrowed floating? What would it cost them? Would it cost them SOFR plus 10? Would you rather borrow at SOFR plus 10 or SOFR minus 15? I'd rather do SOFR minus 15. There's the magic. How did they do that? They must have done that by ripping off triple B, right? Triple B has got to be just so much worse off. So what does triple B do? They borrow floating at what? That's where they have the comparative advantage, SOFR plus 20. Plus SOFR plus 20. They're going to pay triple A T plus 140. And what do they receive? They receive SOFR. Does that all look right? What's their cost after swap? So the S's counts out. So they pay T plus what? 160. Is that better or worse than what they were borrowing before? What would they borrow if they borrowed fixed? Ah, they came out ahead. How is that possible? You may not see how you can figure out how much each of them came out ahead. What's the difference between 60 and 10? 50. What's half of 50? How much did each of them save? 25. What did they do? They split the term structure and credit spreads between them. I say, how can that be fair? Because triple B is lower rated. Shouldn't triple A get more? The swap market doesn't worry about the credit risk of these entities because there's all this collateral saved up. Does that look like magic?
Yeah. Yeah.
They both came out 25 basis points ahead, and all we did was take advantage of the term structure of credit spreads. Pretty magical stuff. I had a friend that worked, he's at Victory Capital now, but he worked for the USA Bank. He found a way to do a swap like this with the European desk. He could save USA about 10 basis points. You multiply that by the amount of debt borrowing they did, that was several $1 million. Like in one little transaction, he paid his entire salary for the year. Those are kind of fun projects, right? Hey boss, you're paying me $1 million. I just saved you 3 million. I think I'll take the rest of the year off. Sounds pretty good. So, all right, we'll stop it there.